So good morning, everyone. Thank you very much for being here. I do appreciate it, and I know it's a commitment for everyone to come out on a Saturday morning when you'd probably rather be sleeping in or doing just about anything else than talking about stock options. But I do appreciate it. It truly is humbling to me when folks show up. So thank you for that. So I want to get going here with the presentation today, and we're going to be talking about long call options and just really sticking to that subject, the long call options, to try and help everyone that struggle when we combine too many things together, making it tough for them to keep up. Now, I do have several slides, and then after that, we'll jump to some charts and maybe take a look at some ideas on where we would look for these trades and what we would want to see in them. So I'll move through these fairly quickly because I know some of this will be a refresh for you folks. And for some, this will be too fast. Slow down, please slow down. But the idea would be for you to go back and be able to review the video as many times as you want. Take this information down. So we'll move through this fairly quickly on the slides. But so when we start talking about options, obviously there's a complication to options, and sometimes that is a little bit overwhelming for folks. Now, the long call options are relatively easy for people to understand, but this quote I always thought was a really good quote, so I threw it in this presentation. Effort only fully releases its reward after a person refuses to quit. And if you think about it, there's probably been many times you've thought, man, I am never going to get this. I'm going to quit. But what I want to encourage everyone is, no matter the complications or the trouble that you're having, please, please, please never give up on yourself. You get in there, you dig in, and you can realize those goals if you just keep working forward. Now, taking it step by step like this, like we're going to start doing, hopefully it will help you do that, to just begin to build that foundation and step through these different strategies one at a time. So first, let's talk about the long call. And the long call strategy is really probably one of the most easy strategies for people to understand. So here's a P&L graph, and this is something that always seems to confuse me. I'm telling you, it took me forever to understand the P&L graph, because how many of you have always gotten hung up on this thing that, there's a break even. When they show these P&L graphs, break even, it has to go to this much to break even. And that always messed me up. I go, wait a minute, what do you mean break even? Well, what they're trying to do is say, if you buy an option here that's in the money, let's say you pick up your option contract here. Well, to pay off or to recover the cost of your trade, the stock would need to move up to make that happen. Okay, it would have to move up to recover the cost of your position, and they call that break even. Now, to be honest, that's just kind of confusing if you ask me. When you're entering a trade, if it doesn't matter if it moves up 10 cents. Okay, if it moves up 10 cents, there's a profit in the option trade account, or the option trade, because the option is moving with the direction of the stock. So that whole concept of break even on a trade really messed me up for a long time, because as you know, you buy a call option, if the stock moves correctly, you quickly make money. So kind of keep that in mind. And when you're looking at one of these, here's your entry, and it's just for those folks, it's a buy to open. I have a problem with my slide there. Just noticed. Sorry about that. So buying that call option contract is a long option position. It gives buyers rights. Anytime we buy an option, we have rights. And when we buy that right, we have the right to profit from that trade, the right to sell that position, and we have no obligation to actually exercise that contract. So the objective, obviously, is to profit as the underlying stock rises in that trade. So option buyers are called holders, and when you hold an option, you acquire rights. And that right is, you pay for that right by paying a premium. The premium you pay is to acquire that right. The right to exercise it. What in the world is going on? I got all kinds of weird stuff happening in these slides. Well, I'm sorry. I don't know what happened here. I'm going to have to fix this. This is not on my slides. I don't know why that's showing up like that. So you have the right to exercise, but not the obligation to do so. And the right to sell the option to collect profits or to stop a loss. So you're free in a call option trade, just really the same way you are in a stock trade. You have the ability to move in and out of that position freely. And the great thing about an option trade is a call option trade is that the maximum profit is theoretically unlimited. So we have an unlimited potential gain in a call option. And our maximum loss is just limited to the premium that we pay for the position. So we have an unlimited potential gain and a limited potential loss. And it always fascinates me because there's a lot of folks out there who say, man, buying call options is one of the worst strategies in the world. And well, if you're doing the technical analysis, if you're already reading the chart, how could it be that way? How could it be that way? It doesn't make sense to me. Because if we do the technical analysis, one of the best things that I think we can have is something with a theoretically unlimited potential profit and a limited potential loss. That's exactly what I'm looking for when I'm looking for a call option trade. So, moneyness and values. This is a thing that always hangs up people initially. I'm going to go through this really, really quickly, but an in-the-money contract is a contract that is below the stock price. That means if you have a $25 stock and you have a $20 option contract, a strike price of $20, that means that you're $5 in the money. At the money, of course, would be a $25 contract because it's right at the money. And out of the money means it would be if you bought a $20 contract, you're out of the money. Or excuse me, a $20, confused myself. We're a $25 contract. If it is a $30 contract, it's out of the money. It hasn't achieved that full potential of the stock. Okay. You need it to rise to become in the money on that position. So in the money, at the money, and out of the money. And then there's the terms intrinsic value and extrinsic value. An intrinsic value of a stock option is the amount that the option contract is in the money. So if you have a $25 contract in the stock, okay, is at $25 or $26, you have $1 of intrinsic value. But if that option cost you $3 a share, that means you have $2 in extrinsic value, time value. And extrinsic value is the thing that adds really a lot of complication to the trading because, excuse me, not extrinsic. Intrinsic value has no no effect on theta or volatility changes, none whatsoever. While the extrinsic value, the time value of an option, is heavily affected by theta and volatility. So you'll always want to remember those two sides of a trade. And what I mean by volatility, I mean implied volatility. Implied volatility changes the price of extrinsic value only. It goes back to, it really goes back to the commodity trading, where there is, if you bought a big lot of, let's say, corn, well, there's a cost of holding that position because you've got a store, right? There's a cost of carry. There's a risk of holding that position because prices will continue to fluctuate. So the time value of an option really comes into that cost of carry. There is a risk for the person who sold that contract, and so they assign a premium value to it. The higher the implied volatility of a stock, the higher the extrinsic value. And that's something you always want to pay attention to in a call option. High implied volatility stocks would not be a good choice for a directional trade because of the cost and the intrinsic value that's in them. So real quickly on the Greeks, let's just take a quick look at the Greeks, and you can study these more. One of the things we talk about all the time is delta, the importance of delta. Now, delta is the amount that a price of an option is expected to move based on a $1 move of the underlying stock. So if you have a delta of 50 and the stock moves up $1, you can expect your option price, your option value, to move up by 50 cents. Okay, a delta of 50 equates to a 50 cent move in a $1 lift in the stock or a $1 decline in the stock. So your delta 50 tells you how much, or it's actually termed a lot of times as the speed in which your option price will increase or decrease in value. The delta is also the probability of how an option will end up at expiration. So if an option is at a 50 delta position, it has basically a 50-50 chance of being in the money at expiration. An option with a 30 delta has only a 30% chance of being in the money, a 70% chance of not making it into the money. Where on the other hand, a 70 delta option would have a 70% chance of being in the money and only a 30% chance of falling out of the money by expiration. Okay? So it's called probability. Now gamma is really, they often call gamma the delta of delta. Gamma, if delta is speed, then gamma is your acceleration. So gamma tells us how fast our delta will change based on a $1 move of the underlying stock. So if we have a delta of 50 and a gamma of 5, if the stock moves up $1, our delta would now be 55. Okay. So it's telling us how quickly our delta will change in value. Now, theta is the amount that an option will decay as time passes, and it's always displayed as, not the percent, but the actual value. So if you have a delta value of 2 cents, what they're expressing is it should have a theta decay rate of 2 cents a day. Now, that theta decay rate always changes based on implied volatility, how the stock is moving, and all of those kind of things. And as time passes, theta increases its decay rate. Because the closer and closer you get to expiration, the less and less chance you have of a big price move that's going to change that option contract. The probabilities start to change. And so if an option is out of the money, the theta has a tremendous effect on that decay rate. It continues to decay faster and faster and faster. Because if it's out of the money, we already talked about intrinsic and extrinsic value. If it's out of the money, it only has extrinsic value, time value. It must be at zero at expiration. Okay? But an option that's in the money, theta has much less effect on that option because our time value is much, much smaller because we have an intrinsic value in that option. So it's really important to know the position of where your option is in that option chain so that you can deal or work with theta. And remember, theta increases its decay rate the closer and closer you get to expiration. Vega, amount that the option price has changed, theoretically, for 1 point change in implied volatility. Vega tells us how much an option price will change in value theoretically based on a 1 point implied volatility change. So as that volatility of an option changes, it's always changing the price of an option. It's moving up and down based on that volatility. So we want to pay attention to that implied volatility at all times. And rho for short-term swing traders is pretty much nothing you have to worry about. Now, if you're a long-term holder of options, rho becomes much more important. As interest rates rise, that affects the value of an option. For a short-term trade, it really has very little effect. So I would say most folks, unless you're really long-term traders of options, most of the time, most folks don't even worry about rho at all. So why do we trade a long call? A long call is a very bullish strategy. It's the most bullish strategy. So if you're thinking long call, you really want to have a bullish forecast on the stock. Not just a questionable, you want to be bullish on the stock. Okay? You have a good purpose, a good reason, a good looking chart, a good setup, whatever it is that you're trying to work out in this trade, but you need to be extremely bullish. It's ready to run. You really think in your forecast of that stock that it's just going to take off and go. Okay, that's the long call strategy. So we want to be all the way up on our bullish meter. We can't be ambiguous about this. We're making a decision on a direction. Okay, it's a directional call. Now, the way I like to use options, call options, is as a stock replacement. Clearly, we can, if we have a bullish assumption on a stock, all we'd have to do is buy the stock and we can make some money with it if the stock does do what we expect it to do. But with an option, we get an opportunity to utilize leverage. And I do it in a way that is meant to replace the stock trade and somewhat mimic it. Okay, and we'll talk about the rules here in just a second, but we want to somewhat mimic that stock trade. So by doing that, I'm always looking at that in the money option. So if we had a $50 stock, you buy 100 shares, it's going to cost you $5,000, but you may be able to get into an option contract for around, under $600. Now you're controlling the same 100 shares. So that's tremendous leverage in that trade. And so using that call option is really that ability to replace that stock trade without taking that huge expense. Now, a lot of people have a misconcept in this because we're risking less money in the trade than we would on a stock trade. But we always get confused in the percentages. Okay? You should always keep in mind that trading leverage is a double-edged sword. You have an opportunity to make a massive potential percentage gain. But the other side of that sword is you have the same massive potential for a percentage loss by using that leverage. But we use leverage if we do our technical analysis correctly and follow along with the trade and have a good set of rules to manage that position. We can limit that risk substantially. But always keep in mind your percentage losses will be larger for the most part in an option trade than they are in a stock trade. Your percentage wins will be larger as well. And we always confuse that because we're willing to take a 3 or 5% loss on a stock. And then we think we can translate that directly into the option trade and only take a 5% loss in an option trade. That's just not going to work. That's setting it too tight. You're going to get stopped out. And so what we want to do is we want to have that tolerance where we can tolerate 25, 30, 40% of that option contract in a pullback for a loss before we start bailing on that trade. Okay. Now the reason we want to do that is we're always going to trade these with a rule of account allocation. How much allocation should you have? Now that's going to be different for everyone, and it all becomes part of your trade planning. The way I do this is I always trade I divide up my account. When I'm taking option trades, I'm usually using less than 20% of my account for options. And that means I have a rule that no more than 3% of that 20% can be used for an option trade. Okay? So that way I'm protecting myself from over trading options. Does that make sense, guys? And you can use whatever percentage you want. I mean, if you have a very, very small account, obviously you might not trade anything other than options. So if you're trading 100% of your option account, I would keep it the same. If 100% of your account is just used for trading options, I would hold to that rule. Around 3% of your account gets used into any one trade. Okay? And that's how we control the additional risk of that leverage. Does that make sense? Hopefully. So where do we want to find these options? What's a good option selection? Well, when I'm looking for options, I am always looking, okay, for option contracts that are somewhere between 70 and 80 deltas. Okay. I will talk about that in just a second, John. We'll go into more detail as soon as I finish these slides. We're just about done with the slides. Okay. So option selection, we want to look for options that are in the money, somewhere between 70 and 80 deltas. That puts us in that true stock replacement strategy. Okay, where we're replacing the stock trade with an option trade, giving us tremendous leverage in the position. Okay, and that sweet spot tends to be around 70 to 80 deltas. That's where we have a high probability in the trade. Okay, remember, anything that's 70 to 80 deltas is going to have a 70 to 80% chance of still being in the money at expiration. Okay, it has value. It won't lose all of its value. Okay. So it's higher probability leverage without overpaying. If we go into that 7 or 80 or above that and go 85, 90, 100 deltas, we're going to overpay for our option and we end up giving up a lot of our potential leverage. Okay. And what typically happens is when you reach up there into those really high deltas where you're 1 for a dollar move, what happens is the market makers just spread the bid-ask spread out. They continue to widen that out. And so that sweet spot where they don't mess with it all that much is in that 70 to 80 range. The other thing that is really good about it is if you're in that 70 to 80 delta area, you have a reduced sensitivity to gamma. Now, why would you want to reduce sensitivity to gamma? We talked about how gamma is the acceleration of our delta. Well, remember, gamma is also that double-edged sword. Okay, if we have a delta of 70 and a gamma that is really, really high, that means that if the stock moves against us, that gamma is going to accelerate those losses. Okay, but generally speaking, when you're in that 70 to 80 delta range, you'll notice that the actual gamma is starting to reduce. The actual acceleration of change of that delta is reduced. So if the stock goes down, you don't have quite so much acceleration to the downside. You also don't have quite so much acceleration to the upside, but it's more stable in that price area. Not as much of this tremendous fluctuation back and forth as you would get at the money or out of the money option. Okay? And it also has a reduced sensitivity to theta. Once you hit that 70 delta area, you'll normally notice where your theta has actually reduced. And that's because time value, or that extrinsic value of the option, is cheaper. There's not as much expectation of this being out of the money. 70% chance plus of being in the money. So there's not very much expectation of this option to be out of the money. Consequently, you pay less or have less extrinsic value, decay rate, lower decay rate. The higher you go in delta, decay rate usually diminishes. Okay, so it's kind of that sweet spot in a trade. So one of the things I talk about a lot, and this is a question that always seems to crop up. First, the delta. Well, why do I have to spend this much for 70 or 80 deltas? I want to buy the cheap one. Well, you just got that explanation. And now, why do I have to buy so much time? Well, we have always all been in trades where we expected the stock to move. And then it didn't. Right? It just kind of laid around there for a while. It was really lazy for a period of time. It doesn't move. And one of the major mistakes that people make in option trading is they don't understand how critically important time is. So I always like to adjust myself to more time because I want to give myself time to be right. We all see in charts good trends, good things going on, but we don't know exactly when that stock is going to move. No one does. But if we plan too short a time, we're actually putting ourselves into a situation where we could be right on direction. How many have ever done that? Been absolutely right on direction. The stock looks like it's going to move for you, but you didn't buy enough time to be able to take advantage of the move. I used to do that when I was new to this trading and I wanted that cheap option and I wanted to do things, as cheaply as I could. And I'd buy that cheap option. Well, it actually prevented me from making money. I would be right on direction, but it took too long to move. And so the extrinsic value made it so I lost money on the trade, even though I was right on direction. And that's one of the hardest parts, okay? One of the hardest parts of trading options is you have to understand we not only, especially directional options, we not only have to be right on the direction, we have to be right on the timing. Okay. So we want to give ourselves enough time. So what I usually use for kind of a general rule is if I'm going to get into a swing trade, I usually try to plan. I think my swing trades have the opportunity to go 2 or 3 weeks. Now, I know that's stretching out there because a lot of trades don't go that far anymore. A lot more volatility in the market. But if I'm thinking that much time, then I want to add 30 to 45 days or more to that trade to get me past that expiration period. So I'm always looking, and this is my general rule, that when I'm looking for a trade, I want to look for option contracts for a swing trade that have somewhere around 60 to 65 days to expiration or more. I want to have a little more time. Okay? A little more time in the trade. That way I can get my expected move. I have time to be right. I can get my expected move and be out of the trade before theta causes me a major problem. Okay? So always think about that timing. And if you want to go longer and longer in those time frames, you need to add additional time to that so that you get that opportunity to really let this chart do what it needs to do, the stock do what it needs to do, and have an opportunity to win. Too short a time frame, you reduce or give up your opportunity to win. And then, of course, having a plan. You guys know how important I think it is to have some kind of a plan. And I put this quote in here. You guys probably never heard of William Feather, but I love this quote. One of the funny things about the stock market is every time one person buys, another one sells, and both think they're astute. You see, the market is nothing more than buyers and sellers. How many buyers are there? How many sellers? A stock moves up because there's more buyers than sellers. That's it. Stock goes down because there's more sellers than buyers. It doesn't matter what happened in the news. The news could create the selling or could create the buying, but the fact of the matter is it's moving based on buyers and sellers. Nothing more. And both of the sides of that trade always think they're right. So that's one of the reasons why it's really, really important to plan your trade and to make sure that you plan enough time on your trade. Okay? Do you ever go into a trade? Now, I've coached a lot of folks, and I always find it funny when someone says, well, I'm thinking about buying this. I'm probably going to lose money on it. Then why would you buy it? If you honestly think that you can't win on the trade, why would you be entering the trade? Does that make any sense at all? Entering into a trade where you have the sense that you're going to lose on the trade. Every time I go into a long call trade, I have confidence that I'm right on the direction. That confidence often gets proved that I'm wrong, but because I've done my technical analysis, because I've done my work, I've done my trade plan, everything is dictated for a directional move up. And if I don't have confidence in that setup or that trade, I shouldn't trade it. And it's really because of this rule, this quote right here. There's always somebody on the other side that thinks it's completely opposite of that. And you have to go in with your eyes wide open into every single trade, whether it's stock or options. But that quote always registered with me in the idea that, wow, yeah, the guy that sold probably thought he was exactly right too. So we have to think about that in every trade that we make, that it's just a matter of buyers and sellers, nothing more. And we have to do our planning and our technical analysis to try and improve the odds to make sure that we have enough confidence that a trade could work in our favor. If you don't believe the trade has the potential to make you money, please don't trade the trade. Please don't do that. It doesn't make any sense. Okay? So some simple rules of engagement here that I use. Never trade without a plan. You guys know I'm really big on entry stop targets and a profit target or a goal for a trade. And you should know those things before you enter a position. Before you enter position. And the reason I say that is because we've all done it, right? Make that quick trade. Don't think about it. All of a sudden realize after you're in the trade that, man, there's a lot more risk in this than I really am willing to accept. Stock starts moving against us. We panic. We make bad decisions. Close the trade before we should. Or not close the trade because we didn't have a plan to get out. We didn't have a plan to exit that trade. We didn't know what the risk was from the moment we entered because we didn't do a plan. If you're not planning your trades, you're just really asking for trouble. Make sure you have a plan in every single trade. Avoid trading illiquid options. I see this all the time when I'm working with folks. Well, let's talk about the trades where you've lost some money. Let's go into those. And we'll look at the option and there's almost no liquidity. Just because a stock trades options doesn't mean the options are worth trading. So we always have to pay attention to the liquidity of those options. And it's far more important to follow open interest than it is option volume. Option volume can have massive moves throughout the day. Big trades going in and out, day trading going on, institutions doing different things. But at the end of the day, all of those may be cleaned up. There may not be anybody holding those. They were just all day trades. What's more important than that is how many shares or how many contracts are being held. So open interest is always more important than volume when you're trying to determine the right trade. Make sure you have plenty of open interest in a trade. Now, I always say minimum 10 times. Now, that's the really bare minimum. For an individual, if you're planning to trade 10 contracts, if you don't have at least 100 contracts being traded, you're really taking a tremendous risk on the trade. Not only that, what you're probably going to find is that next line down is that the bid-ask spreads are going to be really wide because there's not enough trading going on in that position. And so what happens is the market makers spread out the bid-ask spread. Okay, so wide bid-ask spreads can give you a very simple clue to the fact that there might be a liquidity problem. Not enough open interest. There may be a high volatility problem, or there may be coming news events that are increasing the volatility, spreading out that bid-ask spread. So when you look at an option contract that has bid-ask spread that's really, really wide, one of the first things you want to do is you want to check that liquidity, you want to check that high volatility, or check earnings events or news events that might be surrounding that stock, because those will usually be the culprit for a very wide implied volatility. Always check that earnings date. You know, it's specifically pertinent right now in fourth quarter earnings. We're going to be running into a lot of earnings reports next week and the week after and the week after that. Lots of earnings reports. And so we need to really stay on our toes and check those earnings dates, because we've all seen that stock chart that produces just an absolutely beautiful and nearly perfect entry signal just before earnings. And you jump on that trade without making that look, without checking. And then right after the market closes, they report and the stock gaps way down. We've all done that, right? If you've been trading very long, we've made that mistake. You cannot continue to make that mistake. You're really regret it if you don't check earnings. So always check those earnings reports and have a plan based on them. High implied volatility increases the price of an option. We talked about that implied volatility increases the extrinsic value of an option. So we need to be paying attention to that high volatility. If we have a stock that has, and the options are extremely high in volatility, we need to rationalize that and realize that we're going to be paying more for time value. When we pay more for time value, think about this. If time value is really high, it increases our difficulty on one part of that trade. Remember, I said we have to be right on direction and timing. And if we're paying high cost for time, we have to be really right on direction. Okay? Because the higher cost on that time, if the stock moves against us at all, that decay rate or that theta move is going to hurt us more. So we need to be right on top of it if we're trading those really high volatile stocks. We have got to be right on. So think about that when you're chasing around, trying to, only wanting to trade biotechs and really fast moving stocks. You're actually decreasing your odds of a win. Because I don't think anyone here right now could legitimately say we are always exactly right on direction and timing. Okay? And when we look for those trades, we're going to look at charts here in just a second. When we look at those trades, we're always going to be looking for those low risk entry positions. And what do I mean by that? Those are stocks that are at or near price support levels. We're looking for those stocks confirming a price support with buyers starting to step in to support that price. So we can have a really tight entry into that trade and a lower risk on that position. And then always remember to scale out of trades at or near price resistance levels. If we're going to be buying at or near support levels, it only makes sense that we're scaling out of that trade, taking profits at or near resistance levels. Okay? So let's go look at some charts. Now, the question before, let me go back up here. John had a question. Do you adjust your winners back down to 3% if they get too far up? Well, John, that really kind of was answered in that last slide, wasn't it? As it's moving up and we're looking at resistance levels, and if we have a goal in the trade, we should automatically be reducing the size of that position. Okay? You guys see me do that all the time. When a stock moves up for me the way I want it to move up, I'm either taking part of the trade off, I'm either selling calls against it, and that's kind of a different subject, but I'm doing something to reduce my risk on that trade, meaning scale out of that position. Okay? So when a stock moves up, do I adjust it back to 3%? No, I don't. What I do is I start taking profits. I reduce the trade even more of a percentage of my account because I'm putting some money in my account on a consistent basis. Okay? And that's where it really gets into that goal planning, and that's a whole different class. But getting into those goals and making sure you have targets in a trade where you're going to take some profits off. Okay? Now, Bianca asks, does the 3% refer to the max or to the stop loss placement? 3% refers to the size of the trade. The size of the trade. So for example, let me give you an actual example. Mr. Mike Peterson started trading with an account, okay, of $20,000. So he had 20K to trade. So what's 3% of 20K? Everyone reaching for a calculator? 3% of 20,000 is $600. When he first started, that was his limit per trade. That was his size. He could only trade $600 a trade. Maximum. He could trade less, but he could not trade more than $600 a trade. Okay, 3% of the account is your size. Now, why do we do that? Well, first off, if we trade $600, we know that the way we're going to trade, we're always going to have some kind of a stop. Okay, we're going to have a stop in a trade. So if we have $600 in a position and we manage our trade, we know this is 3% of our account. Okay, if we lose half of this position, we lose 1.5% of our account. That's recoverable. You can recover from that. You need a 3% win to recover. Okay, if you trade a giant position in an option trade, it becomes almost mathematically impossible to recover on a big loss. It takes multiple winning trades to recover. So it's much, much better to trade small positions than it is to trade really big positions. Okay? Because we're not right all the time, are we? We have to accept the fact that we're going to lose trades. And if we take too big of positions, the losses will wipe out the wins. Could, not should or will, but could wipe out the wins. So we have to keep our losses small. Now, what I always try to do is keep my losses smaller than that 1.5% if possible. Smaller than that 1.5% of my overall account, because then they're easy to recover from. All right. Now you guys think, I know when I teach this, every time I show this, I get the questions. Well, that just doesn't, it's not enough money. I mean, I can't make money doing that. Hey, if you have a $20,000 account, you're not going to make a living on it. Let's get that clear right now. If you try to make a living on it, what's going to more likely happen is you're going to go broke. Okay? But by trading those small accounts, can you do a good job and make a lot of money doing that? Well, ask Mike. Okay? Last month, he produced $4,000 in profits doing that. Okay? Now, Mike has moved up his account size. He now has somewhere around $900 that he can trade on his positions. But it's because of that dedicated work of just slowly growing and continuing to manage that risk. He's been able to do that. And he's doing $4,000 with trades that are sized about $900 or less. You don't have to trade giant positions to be successful. Okay. So Sean asks, so if I want to trade a 2 contract, open interest of 20 is okay. I would say no, Sean. I gave that because people are always asking, well, what's the minimum? So I said 10 times, 10 times of what you're trading. What I'm going to guess, Sean, is if you look at something that only has 20 contracts of open interest, the bid-ask spreads are going to be wide enough that you're not going to want to trade it anyway. So use a little common sense when you're doing that. There's no perfect rule around that. Okay? I just gave out that 10 times figure to say, if you don't have at least 10 times, you're really taking a risk. Massive risk. Okay? Now, you know me, I work from a watch list. I don't work with any illiquid stocks. I don't even have them in my list. If they're illiquid, they're gone. I don't want to look at them. I have no time for them. I don't care how perfect the chart sets up. I got no time for them. So I don't have to, and you don't have to deal with illiquid options. Just dump them. It makes no sense to trade them. So when I see something like that, I just avoid them. And like I said, unless I want to trade the stock, if it's all set up and I want to trade the stock perfectly, I'll just trade the stock. That's not affected by that option open interest. Okay? But some stocks just trade terrible options. That's all there is to it. And I avoid them like the plague. Why fight it? Take the easy trade. Right? Take the easy trade. Wide bid-ask spread. Here's another one of those things that people want me to give them an exact number, and you really can't, Ken. What is wide bid-ask spread? If you're looking at let's say you're looking at a $15 stock, and you're looking at an option, and there's a 25-cent bid-ask spread, I would consider that to be very wide. But if I was looking at a $140 stock, 25-cent bid-ask spread would not be very wide, would it? So you have to base it on the stock itself, on the price of the stock and how the stock moves and that kind of thing. So what that bid-ask spread might be. And you just have to use a little common sense in that stock trade. Now, if you look at a trade and you may look at a trade and say, hey, I am not going to pay a 75-cent bid-ask spread. I don't care if it's a $200 stock. Then stop looking at it. I mean, it really is that simple. It's a decision you make. I'm not willing to pay that much. Well, then quit looking at it. You can try to negotiate that cheaper. And if you can't get that trade, move on. Okay, so we all have our limits of what we will do and what we won't do. And yours will be different than mine. But just use a little common sense in that trade. I see people that will try to trade a $5 stock with an option contract that'll have 30 cents of bid-ask spread. Why don't you just buy the stock? It doesn't make sense to have 30 cents of slippage on a $5 stock. Buy the stock if that's what you want to do. So it's just a common sense thing that you have to go through and decide what works best and what doesn't. How do you define high implied volatility for any given stock? When you look at a stock, there's two different kinds of volatility, and people easily understand historical volatility. If you look at historical volatility, okay, what it's doing is it's going to take a 1 year period of time And every day that drops off and every day that's added, continues that 1 year period. Historically, what they're looking for is the fluctuation between highs and lows. Okay? That's going to give you your historic volatility. The hard part, and that's easy to understand, right? That makes sense. The hard part about understanding implied volatility is that implied volatility is based on what is implied for the future. And it's implied by how traders are trading the options. Okay? So they look at the contracts, the actual trades that's going on, and that implies a volatility to the stock. Now, by the way, implied volatility cannot be applied to a stock without options. You have to have option trading to get implied volatility. Okay, so it's implied. Think of implied volatility as, that person in your family that's nervous about everything, that's scared about everything. They're always chewing their nails. They're just nervous about everything out there. Really high key. Okay, that's what implied volatility is. It's that guy that's all hopped up on Starbucks and whatever, and all jittery. Okay, just jittery as all get out. That's what implied volatility is. And so when we have events, or we have a stock that's really newsy, or we have a stock that is really moving tremendously back and forth, that affects the way traders trade those options. So the more they bounce that back and forth, the implied volatility rises. Okay? So that's really how you define implied volatility. It's the trading of the options that implies how much movement there is potential in the stock in the future. So it's everybody's trading guesses against everybody else's. That's why it's so hard to pinpoint or really put a finger on what's really going on in there. So when you're trading really high implied volatility stocks, you just have to know that you're taking a significant risk in those trades because of that really high implied volatility. At least when I say when you're buying directional calls. Okay? When you're buying directional calls, we want to really pay attention to that really high implied volatility because we end up paying more for the option. Okay? Now, the way it's calculated is fairly simple. If you have a stock that's $50 a share, okay, and it has an implied volatility of 43%, okay, take 43% times 50. That's going to tell you, that'll give you the value of how much the stock is expected to go up and how much the stock is expected to go down based on how options are being traded. Okay. And that has a direct correlation, to every single day of the stock move. Expected moves can be huge on a daily basis. What is the stop loss I use, percentage that I use on option trades? Scott, I don't use a percentage. I use the chart. Okay? I'm gonna jump to, there's not too many really good charts out there really doing anything great. Well, here, let's look at this go-go. I'm going to throw the volatility stop on this chart. Okay. So if I'm going to trade this trade, we have a trade really potentially setting up right now. Okay. First, we have a trend, right? We have a trend in play here on this stock. So my stop loss will be based on the price action of the stock alone, not the percentage of the option. Because the percentage of the option can change so much based on implied volatility and different things. The only logical thing to do is place it based on the stock chart itself. So we have this stock pulling back. It's holding above its volatility stop. It broke out of resistance and it's holding above that as support. So what we wait for here is we wait for some kind of confirmation. Don't predict it, wait for it. What if this goes a couple, 3 more days sideways? Just kind of bounces around here sideways. Doesn't do much of anything, just bounces around here. And then finally moves over here closer to trend, and then we get that nice bullish signal. All of our little green dots here, our volatility stop holds. The stock is showing buyers at support. So in that situation, I am going to buy that trade and place my stop loss below price support. Now the volatility stop is showing us right here clearly that price support has crossed the top of those highs. So I'm going to get my stop loss below that. Just in case those bears turn the stock back around and want to test that support again. I'm going to be below that so I don't get stopped out. If I try to set a percentage or guess what that percentage is going to be, I'm going to get stopped out a lot. So just use a conditional order based on the price of the stock. You set a conditional order, get me out of this trade if it falls below here. Okay. Now, if you have something that is a long ways away from its volatility stop, that's a clue. Don't trade it. Okay. We don't want to trade something that's gapped up and is a long way from its volatility stop, because that increases the risk in the trade. So what I said in the presentation is I want those stocks, I want those trades that be very, very close to support, at or near price support is where I'm looking for the trade. That reduces my risk in the position. But if you try to calculate it as a percentage, it's not going to work. Moto. So say the market is trending in your favor. So in order to put odds in your favor, how many positions? Are you asking how many positions do I trade? It really comes down to a personal thing. What I usually tell people that I'm working with coaching is you need to get yourself comfortable where you're holding at least somewhere between 5 and 7 trades. Okay? Now, I will hold a lot more than that. If I'm confident in the market, I will hold a lot more than that. And the reason, because I'm only trading 3% of my account in any one trade, I can actually place quite a few trades. Okay, but it comes down to your comfort level at how many you can effectively manage and what your comfort level is. Okay. So in a market like this, would I be running a high number of trades? No. Market's really shaky. I'm going to keep my trades smaller than normal, which means less than 3% of my account. Okay, less than that. And I'm going to be trading fewer positions because of the condition of the market. If I'm really confident in the direction of the market condition, I can go up. It's not uncommon for me to have 15, 20 trades. but they're all small in size, right? You see, if I give myself enough time and take several small trades with really good setups, some are moving, some are not, which means I'm taking profits on some I'm still waiting for. Taking profits on some so I can now add some more trades back. It's a constant flow of in and out and in and out. I know I'm not good enough to just pick one or two stocks at a time and know that they're going to go up. They're going to make me money. They may make me money over the next 3 weeks, but I won't have anything to do for 2 or 3 weeks. I'll just be watching it as it consolidates there and sets and does really nothing. Okay. So I want to trade, if I'm confident in the market, a lot more positions, because I never know which one is the one that's really going to be my big winner. Does that make sense? Let's say you have a win-loss ratio. Let's do this real quick. We've done this before. But let's say you have, here, I'm going to go to a different blank screen here. Let's say your win-loss ratio, okay, is 5 and 5. So out of every 10 trades, you win 5 trades and you lose 5 trades. Okay? So if you put together a trade plan that says, my trade plan is I'm going to try and make twice what I risk on every single trade. So in this situation, if you say I'm going to make, I'm shooting for $200 on my winning trades, I will only take a maximum of $100 in loss on a trade. Well, in that situation, if you look at and you calculate out what you're trying to do, we know our goal is $200 minimum. That's what we're after. Hopefully we can get more. Okay, but during the course of the month, let's say we put on 3 trades and 3 trades and 3 trades. Whoops, can't write. 3 trades and 3 trades every week. We're averaging somewhere around 3 or 4 trades. Okay, so if we're winning 50-50 at the end of the month, we've traded 12 trades, right? That means we've won 6, we've lost 6. If our win-loss ratio stays exactly that. So can we win under that situation? Well, if we had 6 wins, okay, 6 times 200 is 1,200, right? If we had 6 losses at 100, we lost 600. Did we end up positive overall on the month? Yeah, we made money, right? Now, we know that we're not always going to get exactly $200. Okay? But hopefully we're not going to always take exactly $100 loss either on a trade. Now, I'm just giving you these round numbers because it's easy for math, but you guys see my point. We're always trying to take trades that have the ability to make us at least twice our risk. If you're doing anything else, you're going to struggle. But I can prove that you could have a win-loss ratio of less than 5 to 5 and still make money overall at the end of the month. Just do the math. Just do the math. And you can figure that stuff out. It's not that difficult. So when you start getting yourself more and more comfortable to be able to hold more and more trades. If you're putting on an average of 3 to 4 trades a week, you've got to be willing to hold 12 plus trades. Because we maybe put this trade on, 3 trades on this week, and 2 of these trades just take right off, and we can take those off within the week. But these 3 trades that we put on haven't really done anything yet. They haven't moved. Nothing wrong with the trade, no reason to close it. So we have to carry those through. Is that making sense? I hope. I'm way behind on you guys here, so I can't see your answers, but hopefully that's making sense on putting that plan together on how you can make money. It's really just a mathematical equation. It's really simple mathematical equation. Bill's asking, can you use a percent gauge for slippage for option bid-ask pricing? You can. I think Bill, it comes more down to just the common sense of looking at the chart and your risk tolerance. If you just simply don't want to pay, X amount for a bid-ask spread, then stop looking at it. If you can't negotiate and get in it, so it's acceptable, just stop looking at it. I think if you try to overcomplicate that, and if you're trying to put together a spreadsheet or something on bid-ask spread, every stock is going to be different. You have to base it, you have to judge that trade based on the price action, the volatility, and everything that's going on in that stock. It's not a quantifiable code that you can have. There's no perfect science to it. There's no perfect answer to that trade. John's mentioning that most stocks under $10 have really junky options, and I agree. It's really tough. They'll have either really wide bid-ask spreads, they'll be highly volatile stocks, they'll be, for the most part anyway. Sometimes you'll find them. They'll be really low on liquidity. So they're often really bad stocks to be trading options. And that's why I usually say, hey, if you find something down in that range, just buy the stock. If you like the stock, buy the stock. The options don't really give you a whole lot of advantage on those really cheap ones. Okay. Bal. So we can say for optional stocks, the stock options are the real force behind their movement. No. Bal. The stock options are not the force behind the movement of the stock. It's the stock moving that moves the options. Option prices cannot change without the stock moving. Period. So the stock options are not the force behind the stock. It's how many buyers and sellers are in the stock that moves the option prices. How do you analyze a future contract before entering an option for the same stock? When you are looking at, I'm assuming you're talking about a trade into the future. How do you analyze that? Well, first you start with the stock itself. You analyze whether or not the option contract that you're interested in, somewhere around 70 to 80 deltas in the money for that directional trade, has good open interest, the implied volatility is acceptable, the bid-ask spread is acceptable in the trade. Okay? Now you can use any Black-Scholes model. I use what they call the theoretical price model in Thinkorswim. I can put a price and say I think it's going to go up to this next resistance level, which is $4 higher. That gives me a clue about how much that option will be worth up there. I can move it down and say my stop loss would be down here. It will give me a clue what that option price would be worth down there, and I can figure out what the risk reward is in a trade. Okay. So you have to do a little bit of work to do that, but it's really not that hard. How do you recognize high volatility on the option trading screen? Well, every broker is different. Okay. But if I go into TLRY, which is that marijuana, that thing right over here. Look at this. 120+% implied volatility. Just look. If your broker doesn't have implied volatility or the ability to put implied volatility on the option contracts itself, you need to find a new broker. Implied volatility tells us that we have a problem. Okay? This is a very highly volatile stock, meaning we're going to pay a lot for extrinsic value. I mean, compare that with Coke. Coke trades tons more shares. Okay, implied volatility, 20% or less. Okay, so all you got to do is look on your screen. I mean, it's there if you look for it. And if you don't know where it is on your broker's platform, call your broker. You got to learn how to use your platform if you're going to trade. If you don't like the platform, if they don't provide you the information that you need, find a new broker. I know it's a pain, but they don't care about you. Why should you care about them? Tom, the IV and the bid-ask spread are related, correct? So that is the way to determine if the bid-ask spread is too much. They are related in the sense that higher volatility stocks, Tom, with low open interest. What you're going to find when you look at a trade, if they have low open interest, the bid-ask spreads are going to be very, very wide. So I would say the bid-ask spreads are a clue. If you're looking at an option contract, we all do this, right? We just jump right past. We go right into a trade. Let's look at Microsoft. We jump right in, we see something, we jump right in, and we don't pay attention a lot of times like we should to implied volatility. Well, imagine if you jumped in and you buy this weekly and you don't realize that a nearly 50% implied volatility is applied to that option series. So you've paid considerably more for a shorter period of hold in extrinsic value. Okay, if that happens to when you jump into the option chain and it relates to a wide bid-ask spread, now it's unlikely that Microsoft is going to have a wide bid-ask spread because there's usually lots and lots of volume on it, or lots and lots of open interest on it. Okay, but if you find that stock that may have good patterns, good stuff, implied volatility is up there, and you don't happen to check that, if you open up your bid-ask spread and there's a great big wide bid-ask spread, it's a clue to check what's going on. Either earnings may be coming, there's an event that's known about the stock that's coming, the implied volatility is really high in the stock, or it's illiquid. So I would kind of go the other direction, that the bid-ask spread gives you clues to the other things. At least that's the way I use it. Well, implied volatility, I find stocks all the time that have 40, 45, 50% implied volatility. I don't mind trading that. Okay? As long as the bid-ask spread is tight and I'm confident in the technical analysis. Okay? So if I like the market, if I'm confident in the technicals of the chart, and if I look down the series of all of these and it normally averages 40% implied volatility, I'm probably going to be okay as long as the open interest is high enough and the bid-ask spread is tight. You probably can solely find 5 to 7 trades right now, but you're going to have part of them as short trades. But if you only want to trade long trades, you're right. You got to sit on your hands. John, you are right. It gets really, really fun when you start improving that bid-ask spread. And if you follow some of these rules, I would really recommend following all these rules. If you follow all of these rules on these trades, your win-loss ratio should improve. And if we get pickier and pickier, if you get pickier and pickier on your entry, then you have better opportunities in a trade. Oh, Bianca, these up here. See this? See that number right there? 6? These option contracts expire in 6 days. Next Friday. So they're weekly. This is the monthly contract. Okay? A lot of companies will put out weeklies. Okay? 34 because it's the next week past the monthly contract. Okay? They're filling in the blanks in the middle. And there's a question about Adobe. Let's take a look at that Adobe, and then we'll finish this up. Let me read the question. Adobe, as an example, doesn't seem to be a good option trade. Can you discuss? Stock is very volatile last few days, and he's looking at the December, the 21 December call options. So when I look at Adobe, first off, I look at a stock that's being whipped around considerably. It is pulling back to support, but there is no buy signal here. There is no signal to even be looking for an entry into a long trade here at all. Could there be on Monday? Yes, there definitely could be. But look at the length of these candles. Look how Adobe, when it's trending well, look at the length of the candles. The amplitude of these moves has been exaggerated because of the volatility. Okay, so when we see something getting those big, long, stretched out candles, we know that if we take a risk, we're going in that trade, we're going to have to take a higher risk in the position because of the volatility. Okay, so now let's take a look at those December contracts. First off, if you take a look right down this line right here, implied volatility is staying within a range. The shorter term ones are always going to be higher, implied volatility. if there's an earnings date coming, they will get much, much higher in implied volatility. So he's looking at the December 21s. If we open up the December 21s, here's your problem with Adobe. Adobe's a giant stock, right? $244 a share. Look how many people are trading these contracts. The problem with your bid-ask spread is the low liquidity on such a big stock like that. That low liquidity is making the market maker spread out the bid-ask. So if I were looking at this, I would probably say, yeah, I'm just not interested in trading it. Or I would look for something that has more open interest. A little bit more here. And notice that, well, these still stink on ice. So I probably wouldn't trade this at all. I would just move on. Because there's plenty of stocks out there that trade really good options and option contracts. Why waste your time if it's just not something that you're willing to trade? So just move on. Let me use this for example. Pull up, if I pull up Coca-Cola. Now you may not like Coca-Cola, but notice we have substantial, and I'm going to go back to that. Oh, I don't have a December series here. You have plenty of open interest in the trade. Bid-ask spreads are tight. So here we have something that the open interest hasn't changed a whole lot, but look how tight the entries are into these trades. Now, please keep in mind that the after-market prices, when the market's closed, what typically happens anymore is market makers spread the bid-ask spreads at the close. So if you look at Adobe on Monday when it starts trading, the bid-ask spreads will likely tighten. Okay? Happens a lot on evenings and weekends anymore. They just spread the bid-ask spreads out. Have you ever seen in your account, if you've got enough positions on, you'll notice this sometimes, enough option positions, you're up, let's say you're up $500 in your account. The market closes and you look back and you're only up $350. You guys ever seen that? That's because the market makers have spread out the bid-ask spreads. And it almost always normalizes after the market opens the next day, right? So make sure, we're looking at these spreads. Normally I would look at a Coke contract here, and it would be 3, 4, 5 cents bid-ask spread. Okay, and you can see they've spread this out even more than normal on Coke. So kind of keep that in mind. Your Adobe contracts could come back into a relatively good trade after the market opens on Monday. Okay? Always pay attention to that. Okay. One last thing, I said that was it. One last thing I want to do is I didn't really go over what's a good trade. Now, you guys have seen me do this 100,000 times. If I look at a stock like SQ, and I'm using my volatility stop correctly, and I'm working for higher percentage win-loss ratio. Is there anyone in here that doesn't want a higher percentage win-loss ratio? That only wants to trade real aggressive trades? Probably better find a different place, a different room, because that's not going to be me. I want the easy trades. So when I'm looking for a directional trade, I'm looking for a stock that's trending. Well, John, here's the thing. With your comment on that, getting tired of winning, hopefully you understand that good trading is really boring. Because when you wait for good quality trades and enter those good quality trades, you're going to win the majority of those trades, but it's really boring stuff because it's the same thing. You repeat the same process over and over. Like on your shampoo bottle, wash, rinse, and repeat. Okay? We do the same process over and over and over. And winning does, if you're consistently winning, it's kind of boring because it's the same process over and over and over. So if you want to have that high win-loss ratio, then get strict with a set of rules. And you guys know what I'm saying with the volatility stop. You want the stock to be above its volatility stop, and you want it pulling back to support or consolidating towards its trend. So here's a very low risk entry trade. Right here. Stock moves up, breaks its resistance, pulls back, holds as support, moves back over toward its trend, and look what happens. Buyers start to come in and support that. So you can enter that trade, your stop loss is close, and let that trade work. Now, when Mike says something about it's kind of boring, think about this for a second. Now, I know he's joking, but think about this for a second. You want to look for that same thing, that same type of pattern every time. It's the same thing. What do I always say when people give me a stock to look at and that stock is below the volatility stop? Or it's below its trend. It's a stock that's downtrending and it's below its trend. I always say the same thing, right? Wait for the trade to be the right trade. And the easiest way to do that is put good stocks that are trending in a list and just continue to follow that stock, just like we did in this trade in SQ for so long. Just wait for the better trade. Quit trying to predict. Quit trying to over manipulate. There's more than enough stocks out there that we can find to place good trades on. Now, take a look at the difference of this trade compared to what we just looked at Adobe. Is this price action consistent? It's deliberate, right? How it moves. If you're looking at a chart that's whipping, all the way to the top of the screen and whipping back down to the bottom of the screen and just flipping back and forth, great big candles, you're asking for a beating. Just bend over and say, "Thank you, sir. May I have another?" Look for stocks that have deliberate price action, price that you can read, price that's consistent. And then you can make these trades over and over and over just by picking them up when they have low risk entry points and buy those trades. If they're down here, they've pulled back to trend, they're still underneath the volatility stop, I'm going to tell you don't trade it. Most of the time, if you want a high win-loss ratio, can you take a risky trade once in a while? Sure, but don't make a diet of it. Right here, that's where you buy it. Wait for the trade. And when you do that, trading can actually become quite boring because you're repeating the same pattern over and over and over. And by the way, what I'm pointing out here, these are the most common patterns that you're ever going to find in the market. They repeat themselves over and over and over. So we're looking for the same thing, the same pattern every single time. I brought up that chart of go-go. Okay. Take a look at this chart. Isn't this exactly the same pattern? The chart is trending. It moved up above its resistance. It's pulling back toward its support. So all we have to do is wait for our entry. I don't know what that entry is going to look like. I don't have any clue. But I just know when buyers step in here, if they step in here to support this, I want to pay attention to it. So I would do something like this. I would create an alert, put it right about there for right now, and set that alert. That's all I have to do. Okay? I'll look at that stock again on Monday, and on Tuesday, and on Wednesday, and on Thursday. If I have to adjust this alert, I'll just keep adjusting it, waiting for the trade to come to me. I don't have to do anything other than that. And that's honestly all I can do as a trader. I can't predict if it's going to go up. I don't know if it will or not. I just have to wait. And I do know, what I do know is a trend stays a trend until the trend breaks. So wait for the same patterns to repeat themselves over and over and over and get into the trade. And just do that over and over and over and over. Does that make sense? I mean, if you look at this chart, pull this back. If we could enter this trade, here, let me mark this first. If we look up here and see the next price resistance of this chart is really up in here, and I can enter this position with a stop loss that's that close and an entry right here, do I have more than 2-to-1 potential in that trade? Yeah. Do I know it's going to work? Not a clue. I just know that this pattern repeats itself over and over and over, and it has a high probability of winning. I take those trades. It really is that simple. And it doesn't matter what time frame you put that on. You know, I've talked about VXX here just lately because of the volatility of the market. Let's go to VXX. On a daily chart, there's nothing here on the daily chart, right? Nothing here on that daily chart. Well, we know VXX is very volatile. Let's take that daily chart. Let's go to a 2-hour. Can we find any trades on a 2-hour? Well, isn't this exactly the same pattern that we just looked at? Stock moves up, it pulls back, finds support, buyers step in here, enter the trade in here someplace. What about right over here? That's happening right now. It's the same pattern. So you just repeat the same process over and over. It doesn't have to be all that complicated. We're the ones that screw it up, right? We're the ones that make it complicated. We add too many rules that we can't base on anything other than our, well, it's gone up so much it has to come down. No, that's not true. Well, it's pulled back, it has to go up. No, that's not true. We put all this garbage on there. Well, the stochastic says it's going to do this. That's not true. Just watch that price action and wait for the trade. Give up all of that garbage that's causing you problem. Go longer term. Rally to resistance. If this rallied to resistance, we can even look at it weekly. Rally to resistance. Once it gets up here, do you think this could stop and pause or pull back? Highly probable, right? That's a big resistance area. So my guess is if it can get up here, it's going to be a long time before this will be back on a radar for a trade. Yep. Again, you always got to pay attention to that. Okay, can I make a trade in this with 10 days to earnings? Can I make a trade on this, John, and make money? I mean, what's your average hold time? I get this question all the time too. Well, earnings are 10 days away. I can't make that trade. I make those trades all the time ahead of earnings because I know stocks oftentimes like to rally in anticipation of the earnings. "10 days is more than enough time on this to make money." No, I understand that, John, but and I'm not accusing you of anything. I just get that question a lot. Well, earnings are coming. Well, okay. I'm glad earnings are coming, and I'm glad you paid attention to that, but that doesn't negate the possibility of this being a trade. I would agree. Market conditions definitely not favorable for a long trade. I would agree. In fact, if I were a betting or a predicting kind of guy, I bet we see a new low in the market. But I'm going to try to avoid that inclination to just trade the chart patterns that I see. Now we saw it back here. First part of the year, Bob. Tremendous volatility. So we do have to be very, very careful. There's no doubt about that. Okay. So here we go. I was going to do a short class, and now we're almost 2 hours into it. You guys are really good keeping me going. So remember, be pickier about your trades. And if you're going to be directional, remember what I said right at the beginning. If you're going to trade a directional trade, you have to be directionally confident. Not just somewhat confident, not just well, I think so, or not the thing, well, I'll probably lose if I buy this. Don't make that trade. Okay? Be confident in a directional call trade before you take that position. The trade is set up. It's perfectly set up. It's what you want to see. You're expecting that lift in the trade. Wait for it. And then enter that trade, place your plan around it, and work to take profits. Now, one of the things that I've been saying here lately, because I know people want to just trade, is practice. Go to a shorter term time frame and practice. I mean, if you take the diamonds to a 15-minute chart, can we find some trades? Yeah, there's trades in here. Here's long trades in here. There's not really pretty ones. Short trade right there. Okay. So yeah, we can find something to do to practice our price action skills. And remember, it's the same trade setups. You guys, I'm always looking for the exact same things. Move over to trend, buyer stepping in. Move over to trend, buyer stepping in. I'm always looking for the exact same thing. So wait for those trades to set up and practice that skill. Who was it? I don't know who it was. One of the members took a 1 minute chart and was trading a 1 minute chart the other day with what we talked about. And I think had 6 trades during right way options time period, and they were all winners. Was it Sue? See, you can just practice and prove to yourself that the patterns work. That's how you build your confidence. And you can do that with short-term options for a directional trade if you want to practice that skill. Okay. The other thing that you might want to be doing a little bit of is once this market kind of finishes, maybe its correction. We don't know when that's going to be. But when it starts to finish that correction, is if you want to hold some longer term trades, it'll be a great time to buy stocks at a discount. Yeah, well, like I say, Bell, I'm not sure it's done falling. I don't think it's hit the floor yet. Okay. I'm not sure it's hit the floor yet. So everyone, I hope you got something out of this today, and can take that short section of the directional portion of this class and really study that directional portion. And I really want to encourage everyone. Well, just take a look at what Rick is doing. Okay, a 300% return. He can't be prouder of that. He's never seen that before. Trading stocks, you can't do that. A 300% return. Trading calls and puts directionally. Can it be done? Oh my gosh, yes, it can be done. So I would encourage you to pick something like this, that simple strategy, and just work that strategy to get really, really good at it. That's all that Rick has done, is just work that strategy and work that strategy and work that strategy. He's not interested. Could you imagine? He's not really interested right now in even learning spreads or more complicated trades. Hey, I just want to keep doing this. And I think you can understand why. And trust me on this, guys. He follows these rules. I had a conversation with him on Friday where he said, he actually said this to me. I got to thank you for teaching me how to do this, because he goes, this just blows me away that this is even possible. And then I said, the reason you're winning is because you're sticking to the rules. He says, you know what? One of the things that you said to me made the most sense out of anything is give yourself enough time to be right. So he always buys his options with enough time to be right. He always follows the 70 to 80% rule. And lo and behold, you do the technical analysis right, it works. And you don't see him overcomplicating it, do you? He keeps it really simple. He is a great technician. There's no doubt about that. He's a great technician. But you see him do that over and over and over. He waits for the right entry, pulls the trigger on the trade, and he's that's it. He lets the trade work. Doesn't micromanage it, doesn't do anything weird with the trade. And he gives himself enough time to be right. So I want to encourage everyone to just really solidify what your knowledge of that by practicing the price action stuff, because you will see an improvement in your trading if you do. I'm so confident of that. I've just seen it over and over and over. Folks that weren't making any money with just a few adjustments, not big sweeping adjustments, but with just a few adjustments through coaching, have been able to turn their trading around. Okay? You can too. So believe in yourself, keep that work up, keep that effort up, and just keep working harder and harder and harder to improve that skill of that price action and those simple trades. And it'll make a big difference in your trading career. Confident of that. Everyone, take care. Have an awesome weekend. I do appreciate you being here.